Let's look at a number that scares every modern economist to death. 91%. That was the top marginal tax rate in the United States in 1960. Under President Eisenhower, a Republican, and later under JFK, the federal government could legally take 91 cents out of every dollar earned above a certain limit. If you proposed that today, you would be laughed out of the room. You would be called a radical. People would scream that the economy would collapse, that job creators would flee, and that the sky would fall. But here is the uncomfortable truth that history books tend to gloss over. The sky did not fall. In fact, it was the sunniest era in American economic history. The middle class was not just surviving, it was exploding with wealth. We built the interstate highway system. We went to the moon. We built the greatest public school system the world had ever seen. And the average guy? He wasn't worried about tax brackets. He was worried about where to park his second car. This creates a paradox that drives us crazy today. We are told constantly that our taxes have been cut. We are told that we are keeping more of our money than ever before. The top rate dropped to 70%, then 50%, and now it sits in the 30s. On paper, you should be swimming in cash compared to your grandfather. But you are not. You are drowning. You look at your pay stub, and maybe the federal tax line looks reasonable. But then you look at your bank account at the end of the month, and it is empty. Where did it go? If taxes are lower, why are we poorer? This is the mystery we are going to solve today. We are going to look for the missing money, because it didn't just vanish, it was taken. It was siphoned off by a new system of invisible taxes that don't appear on your IRS Form 1040. If you have ever looked at your paycheck and felt like someone was stealing from you, go ahead and like this video right now. We are going to expose exactly who that thief is. Back in 1960, the tax deal was honest. It was brutal, but it was honest. You paid a chunk to Uncle Sam, and in exchange he paved the roads, educated your kids, and kept the national debt low. Today, the deal has changed. The headline tax rate is low to keep you quiet, but the user fees, the tolls, the premiums, and the inflation are bleeding you dry from 1,000 tiny cuts. Your grandfather paid one big bill. You are paying 1,000 small ones that add up to a tragedy. We are going to walk through the brutal math of the 1960s versus today. We are going to strip away the political talking points and look at the raw data. And I promise you, by the end of this video, you will realize that the tax cut you were promised was actually the most expensive purchase you ever made. So, who was actually writing a check for 91% of their income to the IRS? Almost nobody. The 91% tax rate is the greatest piece of propaganda in American history. It was a sticker price that nobody paid. Think of it like the MSRP on a car window. It says $50,000, but if you know the dealer, you walk out paying $30,000. In the 1950s and 60s, the wealthy didn't have better morals, they had better accountants. The tax code was a block of Swiss cheese, full of holes designed specifically for the people who wrote the laws. Let's look at the Collapsible Corporation. This was the favorite trick of Hollywood stars like Ronald Reagan and Cary Grant. If you were a movie star making $1 million, you would owe $900,000 in taxes. That's insane, so you didn't take a salary. Instead, you formed a corporation for a single movie. The corporation took the money, paid a much lower corporate tax rate, and then, poof, you dissolved the corporation and took the money out as capital gains, taxed at only 25%. You just saved yourself 60 cents on every dollar. The oil tycoons had the depletion allowance, which let them write off nearly 30% of their income just because they were pumping oil. The rich were playing a different game. The effective tax rate for the top 1% in the 1950s was actually around 42%. That is not much higher than what they pay today when you add up federal, state, and investment taxes. But here is the twist. While the rich were dodging the 91% bullet, the government was still flush with cash. Why? Because the corporate tax share was massive. In the 1950s, corporations paid about a third of the federal budget. Today, they pay less than 10%. The burden wasn't on the worker's paycheck. It was on the company's profit margin. This is the first key to the mystery. The system was designed to tax capital, not just labor. Today, we have flipped the script. We tax your sweat at the highest rates. while stock buybacks and dividends get the VIP treatment. But the real reason the 1960s worker felt richer wasn't just because of what the rich were paying. It was because of a secret deduction that you lost, and you probably didn't even know it existed. Here is the secret weapon of the 1960s middle class. It wasn't just the salary, it was the tax deductions. Before the Tax Reform Act of 1986, the United States government subsidized your debt. I want you to listen to this carefully. If you bought a car in 1965 on credit, every single penny of interest you paid to the bank was tax deductible. If you had credit card debt, the interest was deductible. If you took out a personal loan for a vacation, deductible. The government effectively paid you to borrow money. It was a massive discount on the cost of living. Imagine if today you could take your car loan interest, your visa bill interest, and your student loan interest, and subtract it all from your taxes. That would put thousands of dollars back in your pocket instantly. This policy created a psychological safety net. It encouraged the American consumer to buy, buy, buy. It kept the wheels of industry turning because debt was cheap. Today, that deduction is gone except for your mortgage, and even that is being whittled away. Now you pay the bank the interest, and you pay the government taxes on the money you used to pay the bank. You are getting taxed on your poverty. This is one of the invisible shifts that transferred wealth away from you. The 1960s tax code was designed to support a consumption-based middle class. The modern tax code is designed to punish it. And then there is the elephant in the room: Social Security. In 1960, the payroll tax rate, the tax that comes out of your check before you even see it, was only 3%. 3%. Today, if you include the employer portion, which economists agree comes out of your potential wages, it is over 12%. That is a 400% increase in the tax on working. We focus so much on the income tax rate that we ignore the payroll tax, which is the true killer of the working class. For most Americans today, they pay more in payroll taxes than they do in income taxes. Your grandfather didn't have that anchor around his neck. He kept nearly 97 cents of every dollar he earned up to the cap. You start the race with a 12-pound weight tied to your ankle. And now we arrive at the silent killer, the tax that was never voted on by Congress, the tax that never appears on your receipt. They call it inflation. I call it theft. In 1960, the government didn't need to tax your income as heavily because the money itself was sound. It was backed by gold until 1971. But when they broke that link, they discovered a magic trick. Instead of asking you for more taxes, which makes you angry and makes you vote them out, they could just print more money. When they print money, the value of the dollars in your savings account goes down. It is a tax on your past labor. You worked for that money, you saved it, and they siphoned away its value while you slept. This created a phenomenon known as bracket creep. This is the dirtiest trick in the IRS playbook. Let's say in 1960 you earned $10,000. You were doing well, but you were in a lower tax bracket. Over time, due to inflation, your salary goes up to $50,000, then $80,000. You feel like you are making progress, but you aren't. You are just keeping up with the rising cost of bread and gas. However, the tax code treats you like a rich person. It pushes you into a higher tax bracket because the number is higher, even though the purchasing power is exactly the same. You are paying rich people taxes on a poor person's salary. The government gets a raise, and you get a pay cut. If you have noticed that a $100 bill at the grocery store feels like a $20 bill used to, leave a comment saying, shrinkflation. That is the tax in action. And it gets worse. We have to talk about the mandatory life taxes. In 1960, healthcare was cheap. College was practically free. Housing was affordable. These weren't taxes, but they were costs you had to pay to live. Today, the cost of these three things has exploded far faster than your wages. So even if your official tax rate was zero, you are still paying a survival tax that your grandfather didn't have to worry about. He could pay for a berth in a hospital with cash. You need an insurance plan that costs as much as a second mortgage. When you add the income tax, the payroll tax, the inflation tax, and the survival tax together, the modern American isn't keeping 90% of their money. They are lucky if they keep 10. So we return to the original question. Where did all the money go? It didn't disappear, it shifted. In the 1960s, we had high nominal taxes, but a low cost of living and massive deductions. It was a system that rewarded working, saving, and buying a home. Today, we have low nominal taxes, but a high cost of living and almost no deductions for the average person. We moved from a system that taxed the profits of the few to a system that taxes the survival of the many. The 91% tax rate was a myth for the rich, but the 90% survival tax is a reality for the poor and the middle class. The hard truth is that you cannot vote your way out of this. The tax code is a living organism that evolves to protect the people who write it. And they don't write it for you. They write it for capital. This is why a billionaire can pay a lower effective tax rate than his secretary. He pays taxes on capital gains. She pays taxes on labor. The lesson from the 1960s isn't that we need to raise taxes back to 90%. The lesson is that we need to understand the game. The people who are winning today are the ones who stopped trying to win the salary game and started playing the asset game. They buy things that inflation pushes up, real estate, stocks, businesses, rather than working for a currency that the government pushes down. Don't let the nostalgia blind you. We can't go back to 1960, but we can learn from it. We can see that the tax cut was a Trojan horse. They gave you a few extra dollars in your paycheck, but they took away the roads, the cheap college, and the honest money. They handed you a discount coupon while burning down the store. So the next time a politician tells you they are lowering your taxes, check your wallet, check the price of milk, check your health insurance premium. Because in this economy, what they give with one hand, they almost certainly take with the other. If this breakdown helped you see the invisible taxes in your life, make sure you are subscribed. We are going to keep digging into the financial history they don't teach you in school. The system is rigged, but if you know the rules, you might just survive it.